I'm Dan Pascone, CEO of Tailored Wealth and host of the Making Sense of Your Money podcast, real conversations to help high earners make sharper decisions so their money works as hard as they do. This is episode number 51, and today I'm joined by Justin Detray, partner at Wealthspire Advisors, to break down the behavioral biases that quietly drive bad investment decisions, such as recency bias and anchoring. If you want clearer thinking in volatile markets, this one's for you. And before we dive in, make sure you're subscribed on your favorite platform. And if you find the show valuable, I'd really appreciate it if you leave a quick review. Thanks so much and enjoy.
Brought to you by Tailored Wealth, helping business leaders live their version of a rich life.
Welcome to another edition of the Making Sense of Your Money podcast, where we cut through the financial noise and help business leaders to make smart, confident money decisions. All right, Justin, thanks for joining the Making Sense of Your Money podcast. Excited to chat with you today, brother.
Thank you, Dan. I'm happy to see you, and I hope you're surviving the snowmageddon back east.
It's been a rough winter, that's for sure. As I told you beforehand, I am ready for golf and baseball, but that feels a far cry away at this point in time. But
it's only February, my friend. So
it is indeed. All right. Well, listen. Before we hop in, I got a bunch of stuff I want to chat with you about. I know you've got a really interesting story and a unique perspective on personal finance. So I'm excited to dive into that with you. Tell us a little bit about your background. Give our audience a sense of who you are, what you do, and how you've gotten into the role you're in today.
Excellent. Thank you. How did I get into this role? It's actually a pretty linear story. Although when I tell it to people, it doesn't seem that way. So I was, 28 years ago, 30 years ago, I was in undergraduate school, graduate school in New York City. I studied astrophysics, which is relevant only in the sense that I have like a sciencey, evidence-based background to all this stuff.
Okay.
I took some time off from a PhD program and became a proprietary trader down on Wall Street in 98, and then never went back, and then traded for the next 14 years professionally and ran my own prop shop, which is kind of like a very small hedge fund in a way.
Sure.
I was in New York City, moved out here to California, decided I was ready to do something else because trading is a grind. If you're doing it, it's like, it's just a grind, and switched to wealth management probably 13 years ago, maybe 14 years ago. And in many ways, it combines all the things that I like doing, which is analyzing problems. I love the markets. I love the psychology of the markets, and I love working for my clients. The behavioral aspect of not just the markets, but of clients and in making investment decisions is probably the most interesting thing to me. And so that's where I am now. So I'm an advisor at Wealthspire. I'm a managing director. I have probably 130 clients. And as I mentioned to you before we got started, my goal is to be super high touch with my clients, very available, and have good relationships, like close relationships with them. That's what makes the job really fun for me, in my opinion.
Very cool. Very cool. Thanks for that breakdown. Talk a little bit about, your unique studies and sort of like that career track, and then shifting into personal finance, and maybe what you took from that upbringing and some of your studies and have applied to the wealth management.
That's a cool question. I would say that, there's many different kinds of financial advisors, and you can be very successful being a pure CFP financial planner that's got no market IQ, is what I call it.
Right.
And that's fine. And you lean heavily on your investment team to do research, to build portfolios, and you can be very successful, and you can really serve your clients while doing that. That's not my style of advisory services. I do a lot of research on my own, probably based on those 14, 15 years now, 28 years of watching the market every day. And I still do trade for myself because I think that having my hand in the game, so to speak, keeps my brain engaged, but also keeps me very close to the pulse of the market and sort of the current zeitgeist. That is not something you need for good long-term investing and management, but for answering client questions and concerns about what's happening today or a week from now or a week in the past, it's served me really well. So I do a lot of my own deep research on markets and volatility and correlations, and weave that into storytelling with my clients about what's really happening in the market versus what they might be reading in the news. And I think that's probably one of my sort of differentiators from a lot of the advisors that I know. is that I do a lot of self-research. I would be doing it anyways because I find it fascinating, but it's really in service of answering questions with clients about what they've read in the news versus what's actually happening.
You bring up such an interesting point. So I want to touch on two things that you talked about there. You mentioned how important the behavioral aspect of personal finance, investing, financial planning is. And then there's the media, right? And that's the big 800-pound gorilla. So talk a little bit about, let's first focus on, what do you see the typical investor, what do you see as far as challenges the typical investor faces when it comes to behaviors impacting their finances? Let's start with there, and then we'll evolve into some of the stuff and the impact that the media has.
I think it's the big ones that you would come across if you were studying behavioral finance or economics at a place like Berkeley that kind of pioneered some of this research with Daniel Kahneman and Thinking Fast and Slow. I think there's the recency bias is a huge one that I think we see all the time as advisors in one form or another. I think the anchoring bias is another one, which is
talk about that. Tell us about anchoring bias. Explain that to our audience.
Sure. So I'll do both. So recency bias basically is this bias where humans tend to think what's happened recently is going to happen again, although it can kind of happen in a variety of ways, but that's a really common one, right? The S&P has gone up for 3 years in a row, so it's going to go up this year also. Now, it doesn't have to. That's not necessarily what's going to happen. The anchoring bias is, you see it most frequently with people with stocks, specifically if they've had, IPOs or they work at a company that's gone public. Stock ABC was at 35. It's now at 10, so it has to go back to 35. It doesn't have to go back to 35. Or right. I bought gold at 5,000 and now let's fast forward 2 years in the future. It's at 3,000. It's going to go back up. It might take 10 years. I have no clue. So it's that idea of anchoring on, it's like recency, but it's anchoring on something in the past that you think you're going to return to that when it really doesn't have to happen that way. Both of those, I think, are things that we deal with as advisors all the time, although we may not call them that specifically.
Yeah, that makes a lot of sense. Now, fast forward to the information age that we're in, right?
Yeah,
where information is so readily available, so in your face. How do you feel that impacts investors, markets, and how people ultimately plan their finances?
Okay, this is a great question. Investors specifically, I think that in economics, there's two things that you're taught in economics that I think don't help you as an investor. And one is that humans make rational decisions, right? We're all trying to maximize profits or minimize costs or something like that. And if you spend time with your fellow humans, they're not rational all the time. Maybe they're rational 70% of the time, or maybe it's 95% of the time. But in those tails, people can make very bad decisions because they're not actually being rational. And the other one is that whole concept of perfect information. And I think that nowadays, and I kind of had this thought about 10 years ago, one tends to think there's so much information, it's so readily available because of Google, for example, 10 years ago, and maybe now because of AI, that investors have more information now, people do in general, than they've ever had before. And therefore, I think one might think that humans or investors are able to make better decisions as a consequence. I think in reality, there's so much information that it allows people to make more decisions, not necessarily better decisions. And as a consequence, they make more, type 1 fast thinking decisions, not type 2 slow thinking decisions. And technology has been built out at the brokers such that you can act upon that instantly. You don't have to call your broker at Salmon Smith Barney and ask him to place a trade for you, where he might have an opportunity to, talk you off the edge or talk down some of the animal spirits. You can just click on your phone and liquidate your portfolio if you want, circumventing your advisor, actually, if you felt like doing it. So I think it's actually super interesting. There's so much information. The media has shifted kind of away from a traditional fact-based media, not like writ large, but a lot of it. And I think there are many, many opportunities for investors to get triggered emotionally and make bad decisions. I think one of the most important takeaways I got from being a trader for so long was that you're constantly trying to be off tilt all the time, right? The gambling phrase tilt, where you're making bad decisions. You're constantly trying to be calm in your thinking and decision making. And I think that's the best state of mind to be in as an investor. but the news is constantly pushing you towards making quick decisions, rash decisions, and the tools are all there to act on them.
Yeah, well said. Now, the follow up to that is how do you, especially given your unique background and what sounds like something, both from a behavioral aspect and a markets aspect, sounds like you study and you're very passionate about both of those. How do you take your expertise, your knowledge, your background to then go coach your clients to avoid some of the challenges that you just articulated?
I think for me, and I don't think that everybody has to do it this way, it starts, as I said earlier, with kind of understanding what clients might be feeling before they pick up the phone and call me or send me an email. That just
Okay.
means having a general sense of what the news is on both sides of the aisle. What is the current zeitgeist out there? What might be stressing clients? And that's not that difficult to do if you listen to a few podcasts or read a few Substacks or read the news. The second is allowing a client to tell you what's bothering them and not trying to guess. So while I want to have a general understanding of what it could be, I'm not going to make assumptions about what's keeping them up at night if something is. I really want them to tell me and I really want to listen. I really want to spend as much time listening to clients as possible without having my own personal bias so that I can understand what they're worried about and then talk about that specifically, but do it in a way that's very accessible to anybody. No jargon, no fancy words, breaking down what might be a complex idea, sort of into an easily understandable narrative.
I think that's such an important role of any financial advisor and planner is being able to take these complex concepts and break them down in a way that's easy to understand. And what I always like to say is ultimately be able to have the client understand how it impacts their life, because that's what we're doing this all here for. That's what this whole money thing is here for, is to help us live our best lives. What challenges, what do you find in today's day and age? When I say today, I mean like 2026, because it seems like the headline changes every minute. What sort of things keep clients up most at night right now? And, what are the conversations that you're having around those, Justin?
Right now, I think that to your point, it changes every week or every 2 weeks. And it's really not because the news changes that frequently. I mean, the things are happening quickly in the AI space, but it's because of I think it's because of the way that the media cycles through topics. It's very metric driven. It's all about maintaining focus, maintaining attention, clicks, selling ads, etc. And it's just so easy to monitor that stuff. So if you're writing articles for a paper or for a website, you can very easily tell when a headline is no longer grabbing attention. Right now, I mean, in October, at the end of last year, it was AI bubble, hyperscaler bubble.
Yeah.
That was a big one. I think we're back into, this funny place where investor sentiment is actually kind of negative right now, but the markets are more or less like 2% off all-time highs. Some of the old guards, some of the old leaders are having a hard time, but the rest of the market's actually doing fine. Sort of the quote, old economy is doing fine. And I think that it's really helpful. You mentioned this a second ago. I think it's always helpful to take whatever is worrying somebody today and connecting and relating it to their long-term financial plan. How does this really affect your 10, 20, 30-year plan, multi-generational plan? And most of the time it does not. And it's also so impossible to predict the future. Nobody knows. None of us in this business knows what's going to happen a year from now. We're all just making educated guesses. And it's really important to have the humility to understand that I might have a story around what's happening with AI or with industrial companies right now, or a rotation between large stocks and small stocks and why that might be happening. What might happen with the Supreme Court ruling? What might happen with inflation? They're all just educated guesses at the end of the day. So I think that it's important to know what's happening every day, but it's also important to keep clients focused on that 30-year time horizon, or 10 or 20 or 50 or whatever it is. And be really, really humble, because none of us know what the market's going to be doing 6 months from now or 12 months from now, at least in my opinion.
Very cool. Very cool. All right. That's a great backdrop. So I want the audience to get to know you a little bit more now. So tell us a little bit about maybe an experience, whether it be in business or life, that's shaped how you think about money today?
I mean, I think that I think that actually my relationship with my wife has been a huge impact on how I think about money. I mean, I can split this into two parts. I'm going to split it into that part first, and then I'll tell a little anecdotal story about Professor Siegel of Wharton and reading his book in the 90s. I think that, I kind of have that attitude that everything's going to work out somehow in the future. I'm sort of naturally optimistic,
Me
and
too.
I don't necessarily know how, but I believe it's going to work out fine. And my wife grew up in a very different world. She grew up in New Orleans. She had financial problems growing up, and she views money very differently than I do. I sort of think that we'll be fine. We'll figure it out. And she always wants to have a plan to make sure we're going to be fine and figure it out, which is funny because I'm the financial planner. And
My wife and I have a similar relationship. That's why that's why I'm laughing.
good. So I think that for me, through her and through my clients, and probably you through your clients, the impact on somebody's well-being, lowering the anxiety level, helping them sleep at night, et cetera, by having a long-term plan, and actually reviewing it regularly,
Yep.
even if the numbers aren't changing that much, it's really demonstrated to me how much, while I take things sort of like a leap of faith that's going to work out, not everybody does. And that's been very impactful for me to understand behaviorally how important the work we do can be in terms of helping clients understand that they're going to be okay in the long run, especially when the media is constantly suggesting that the world's going to end in 6 months because Skynet's going to wake up and eliminate humans or something silly like that. And I'll tie that back to when I read Stocks for the Long Run in 1998. And this is sort of a really pivotal moment for me from an investment perspective. So I was a prop trader. I started to make money in 98, 99, 2000. Maybe in 2000, 2001, I read Stocks for the Long Run, and by Professor Siegel at Wharton. And it completely changed my view of investing. And I've essentially been, or my wife and I have been, invested in equity markets since that point in time, like the whole time. And we've stayed the course. We've never gone to cash. We've never panicked. We've never kind of gotten over our skis. And, 26 years later, 27 years later, compounding growth really works correctly. And tying those two things together for me, having been an investor for 28 years, 27 years, and seeing how as our net worth has grown just with time, right? Einstein once said that compounding growth is the eighth wonder of the world. The peace of mind that it's brought my wife, but it takes time and it takes discipline, and, it takes controlling those behavioral impulses that can derail you both in bubbles and in crashes. So both of those things together have really impacted how I show up for clients and try to steer them through distilling the short-term noise and keeping their eyes on the long-term time horizon.
It's a great segue into the next question I wanted to ask you. So I know you deal with a lot of successful people, successful professionals. What's something that successful, oftentimes high earning, high net worth professionals commonly misunderstand about money?
Commonly misunderstand about money specifically, not about investing, right?
It all ties together. So whatever angle you want to take that,
I'll do both if that's okay.
please.
I think it's related. The two are related. I think a lot of my clients actually don't understand intuitively what compounding growth does.
Right.
And what I mean by that is I think many of them at the end of time will have more money than they actually meant to have for their heirs, maybe not for charity, for charity, but not too much money, meaning they may not actually be living today. Maybe they're not spending as much money today as they could, because they don't quite understand what compounding growth is mathematically. And so I do actually like to try to help clients realize that if there's something that they're not doing because they don't think they can afford it or they don't want to spend the money, I really want to help them understand that they probably can, and showing that to them in whatever format sort of resonates with them. And I think that that's an interesting situation that I see with a lot of my clients. At the end of time, if I said, hey, you're now 92 years old and you have X dollars, is that really what you meant to have? The answer is probably no. And also, in lieu of that, do gifting, do charitable donations now. Don't wait until the end of time to make those gifts to either friends, family, loved ones, or charities that you really, really want to support, which is kind of funny. But I think that financial advisors can be naturally slightly risk averse because, of course, we don't want our clients to run out of money, and we want portfolios to grow over time. But I really want to balance, having more AUM as an advisor with for my clients maximizing their own personal happiness. And I think a lot of my clients aren't maximizing their own personal happiness. I think the interesting thing, the question I thought you were going to ask is, a lot of my very successful clients, whether they are in tech or they had small businesses, are very used to being able to control outcomes.
Mm-hmm.
And this is a fun question. This is a behavioral conversation about markets. If you're looking long-term, 10, 20, 30 years, I think there are very safe, bettable outcomes in portfolios. But if you are trying to react to the news in a way that seems logical and make changes to your portfolio, the probability is very much stacked against you. And you can look at any number of studies on active management versus passive management. You can look at simple things like, what did the bond market think the Fed was going to do last year over just 12 months? And you'll see just this wave of probabilities moving as data comes out. So I think that from an investment perspective, people will read the news or they'll think something like, well, I think, interest rates are going to come down in June. Shouldn't we make a change to the portfolio? Because they're used to reacting that way while running a small business. Right. And they don't quite understand that that's already inside the market, that's all priced in somehow.
It's already baked in
into the market. And it's pretty hard to outguess the market, in my opinion. So two slightly different answers, but really helping clients understand what the money is there for and how much might be there in 10 or 20 or 30 years if it's compounding, and trying to get them to maybe take advantage of that now and not die with too much money, basically.
Yeah, well said. I mean, that's a powerful statement there, right? Because what's it all for? It's about,
what's it all for?
Living your life, right? I'm with you. All right. Great stuff, Justin. We are now ready to get to know you on a deeper level. So you're now entering the lightning round. Are you ready?
Okay. All right. Yeah, let's go.
All right. So the lightning round is just first thought that comes to your mind. One word answer, long drawn out thought, or anywhere in between. All right, let's do it. One meal for the rest of your life. What is it?
It can be like a complex meal, not just a dish. Sorry, I'm going to overthink these.
Yeah, typical financial planner. If you had to just, it could be anything. Any meal, you got to have it though for the rest of your life. What are you going to have?
Man, that's going to be rough. It's probably going to be steak and eggs.
Yeah. Okay. All right. I like it. All right. Give me a tool or technology other than your computer or your phone that you can't live without.
I mean, I actually would have a hard time living without my car. And not because of I need to commute to work, because going for drives for me is maybe like playing golf for you.
Okay.
It's where I do a lot of thinking and a lot of talking to myself and maybe hashing out the way I want to present an idea. And it might be my morning commute or my evening commute. It might be a Saturday morning drive. I do a lot of thinking in my car. It's like it's my me space. And I don't know if that answers the question, but I really like alone time in my car sometimes, not just sometimes, like frequently.
I love it. That's a good, unique answer. I know that you're a historian when it comes to finances. Do you have a favorite quote or phrase about money or even success?
I mean, it is. Well, there's two quotes, but this one, my absolute favorite quote. So when I was in New York City, when I was in college and graduate school, I boxed. That was my main. I'm not studying. I'm not hanging out with my then girlfriend, now wife, who I met as a sophomore in college. I boxed both in Manhattan and in Brooklyn at Gleason's. And I think the best quote ever for finances is everybody's got a plan till they get punched in the mouth, by that incredible financial guru, Mike Tyson.
Iron Mike.
I think that expression is so right about investing that it's not necessarily intended for that, but that's my number one quote for sure.
I'm a huge Tyson fan myself. My dad was always a huge Tyson fan. So I love that. It's one of my favorite quotes. And I don't think it even extends just to financial planning. That I don't think Mike intended it to be such a like poetic and like prophetic statement that he made that like applies to all walks of life, but it certainly has become that. That's one of the best ones there is. There's no two ways about it. What is a habit that you use or you do regularly that's had a major impact on your success?
That's a great question. Actually, and it started with a book called Atomic Habits. And
one of my favorites.
Yeah, great book. I have a habit tracker over there, which is like the little book you write your stuff in. I think the single most impactful thing for me was to structure my days around waking up at 4:45 a.m., which sounds like, I guess, so generic, David Goggins or that like one of those ex-Navy SEAL guys. But getting up at 4:45 every morning and having quiet time for an hour in the morning to read and to think and sort of prepare for the day. That's just anchoring in a different way on 4:45 for me basically is a forcing mechanism for going to bed a little bit earlier, eating a little bit earlier, paying attention to what I eat for dinner so I have high quality sleep. It kind of backs you into having good sleep, having a healthy lifestyle, and you can do whatever you want with that time in the morning. But for me, that when it's dark outside still and it's 5 a.m. or 5:30 or whatever, and especially when my daughter was still home and everybody was asleep in the house, that was such sweet time for me. And I think that that's probably the most impactful thing, getting up early and getting and doing a little self-care, doing like maybe a little weightlifting, a little stretching, very brief, 20 minutes, reading the news, checking out the markets, thinking a little bit, reading, writing a little bit. That's a really, really powerful habit for me or routine for me.
You and I have a similar habit from that perspective, so I totally subscribe to that one. All right, what is a purchase or investment, could be large or small, that's quietly improved your quality of life?
I guess it could be, I guess it's both. So the house we live in right now, we bought in 2015. And my approach to buying real estate, which just means my primary residence, has always been buy whatever house you can afford in the quote nicest neighborhood. However you define that. I've always defined that as where are the best schools, because if you use that as your filter, then it's probably a safe area to live. You're probably going to maintain the value of your home, which when we bought our first place back in Brooklyn Heights was our largest asset by far. Our house in Tiburon is not like that now, but it's still a big asset. So we bought this house in 2015, and probably 4 years ago, we did like it was outside the house. It wasn't inside the house. It wasn't a remodel. It wasn't a new kitchen. It was changing our landscaping, working with a landscape architect, changing the landscaping to make the outside of the house, the backyard, which is a big hill, the front of the house, to make it all like a little sanctuary when I come home every day, and a sanctuary for my wife when she comes home every day. So could it be an investment? Could it improve the value of the home? Sure. Definitely was a large purchase because nothing's cheap anymore. But that had a shockingly positive benefit on my general happiness, just to look out the window when I wake up and see something beautiful in the morning.
Very cool. I love that. All right. And then finally, if our listeners want to connect with you, collaborate, work with you, what's the best way to reach you?
I guess I should probably say my email address, Justin.Detray at Wealthspire.com. In reality, it's the cell phone. You want to text me, 917-647-5396. Going out on a limb here. Don't blow up my phone, but text is the number one way.
I love it.
Dan's like, I'm going to edit that out. That's crazy.
Yeah. Hey, if you want our audience having your cell phone, then that's great. Now,
Give me a
let
call.
me know. Yeah, that sounds good.
I'll let you know how it goes, man.
All right, that sounds good. Let me know. Keep me posted. All right, Justin, this has been a lot of fun. Thanks so much for your time and your insights today. Appreciate you coming on, man.
Dan, thank you so much. It's a pleasure to talk to you. I love your energy. I would love to get a cup of coffee with you next time on the East Coast.
That sounds great. Let's absolutely plan to do that. That is it for the episode. You can find our podcast along with our newsletter and our YouTube channel, all for free at makingsenseofyourmoney.com. And as always, prioritize your version of a rich life.